Stocks plunge as tariffs and weak job data hit markets. U.S. stocks plunged on Friday as new tariffs and weak jobs data triggered a sharp sell-off, marking the biggest daily percentage decline in over 2 months. The S&P 500 suffered its largest drop in nearly a month, with Amazon.com, AMZN.O, facing an 8.3% plunge after disappointing quarterly results for its cloud computing unit. President Donald Trump's recent executive order on tariffs, targeting countries like Canada, Brazil, India, and Taiwan, added to the uncertainty, while job growth slowed more than expected in July, raising concerns about economic stability. The Federal Reserve's rate cut expectations surged as the labor market slowdown hinted at a potential shift. "There's no way to pretty up this report," said Brian Jacobson of Annex Wealth Management, noting the Fed's previous miscalculations and the likelihood of similar actions this year. The Dow Jones fell 542.40 points. The S&P 500 lost 101.38 points, and the Nasdaq dropped 472.32 points, hitting record lows. Amazon became the biggest drag on the market, pushing the Consumer Discretionary Index down nearly 3.6%. Apple, AAPLO, also faced losses, as CEO Tim Cook warned U.S. tariffs would cost $1.1 billion annually. The firing of BLS Commissioner Erica L. McIntyre following weak jobs data sparked debate, with one analyst calling it irregular, while others questioned its political implications. Meanwhile, the Fed's resignation of Governor Adriana Kugler, allowing Trump to appoint a new leader, added to the volatility. The market saw a 2.17-to-1 ratio of declines versus advancers, with the S&P 500 posting 8 52-week highs and 29 lows. Volume rose to 19.51 billion shares, up from the average of 18.44 billion. As the economy teeters, the question remains, will the Fed's rate cuts stabilize markets, or will geopolitical tensions deepen the crisis? What could get more expensive from Trump's new tariffs? Tariff impact explained. The potential for rising costs due to President Donald Trump's significant tariff increases is a pressing concern for many Americans. While Trump has asserted that these tariffs will not lead to higher prices, the reality is that inflation, which has been relatively stable, is beginning to rise as a direct consequence of these trade policies. Starting next week, the latest wave of increased tariffs on imports will make goods from certain countries more expensive for consumers in the United States. Although businesses have attempted to absorb some of these costs, they may soon have no choice but to pass a portion of these expenses on to consumers, resulting in higher prices for everyday items. So, what specific products are likely to see price hikes? Let's break it down. Computers and electronics. Computers rank among the most imported goods in the United States, according to data from the U.S. Commerce Department. The primary exporters of computers and electronic devices to the U.S. include China, Mexico, Taiwan, Vietnam, and Malaysia. Currently, products from China are already subject to a minimum tariff of 30%, although some exceptions apply. If a trade agreement with China is not finalized by August 12th, these rates could escalate even further. On the other hand, goods from Mexico can enter the U.S. without tariffs if they adhere to a trade agreement established during Trump's first term. Meanwhile, products from Taiwan, Vietnam, and Malaysia are poised to face nearly double their existing tariff rates by next week. Although overall price increases have been modest, data from the Consumer Price Index indicates that computers were approximately 5% more expensive in June compared to the previous year. India, while not a leading source of computers, still plays a significant role in supplying electronics to the U.S., with goods from India facing a minimum tariff of 25%. Economists at the Yale Budget Lab project that if these tariffs remain in place indefinitely, prices for computers and electronics could surge by 18.2% in the short term, defined as 2 to 3 years, and by 7.7% in the long term, 3 to 10 years. Apparel. Much like electronics, a significant portion of clothing sold in the U.S. is imported. with major suppliers including China, Vietnam, Bangladesh, India, and Indonesia. The tariffs imposed by Trump on these countries are expected to have a substantial impact on clothing prices, which are among the top imported goods in the U.S. The Yale Budget Lab estimates that clothing prices could increase by 37.5% in the short term and 17.4% in the long run. Wristwatches and leather goods. Wristwatches, particularly those imported from Switzerland, are another category that will be affected. Switzerland, a leading exporter of watches to the U.S., is facing a hefty 39% reciprocal tariff. Last year, the U.S. imported over $4 billion worth of Swiss watches. Additionally, prices for leather products, which often include watches, are projected to rise by 39.7% in the short term and 18.9% in the long run. Footwear, shoes primarily manufactured in China, Vietnam, and Indonesia will also see increased tariffs starting at a minimum of 19%. Many types of shoes are made from leather, which means they could experience similar price hikes as wristwatches due to the tariffs. Alcoholic beverages. The U.S. alcohol market relies heavily on imported wine and spirits, which account for 35% of total sales, according to the Wine and Spirits Wholesalers of America, WSWA. Tariffs on goods from the European Union, a key supplier of alcoholic beverages like wine, whiskey, and vodka, are set to rise from 10% to 15%. Toys and furniture. Vietnam is the leading source of imported furniture, followed closely by China. Additionally, these two countries are the primary exporters of toys to the U.S. Toy manufacturers have already begun warning consumers about potential price increases due to the tariffs on Chinese imports, and the new tariffs on Vietnamese goods are likely to exacerbate this issue. Interestingly, businesses have not yet fully transferred the costs of tariffs to consumers. In anticipation of rising import taxes, many companies spent months stockpiling goods, which is why economists at Goldman Sachs estimate that it takes about 8 months for the impact of these increased costs to be fully reflected in consumer prices. As we navigate these changes, it's essential to consider how these tariffs will affect our wallets. Are you prepared for the potential price increases on everyday items? What are your thoughts on the effectiveness of tariffs in protecting American industries? Share your opinions in the comments below. U.S. stocks slump amid tariffs and job report weakness. Market mayhem. Stocks plummet as tariffs and weak jobs data strike a devastating blow. Imagine waking up to a stock market in freefall, with the S&P 500 suffering its largest single-day percentage decline in over 2 months. Welcome to Friday, August 1st, 2025, a day that will be etched in the memories of investors for a long time. But here's where it gets even more intriguing. The perfect storm, tariffs and soft jobs data unleash chaos. The U.S. stock market slumped dramatically on Friday, with the Dow Jones Industrial Average plummeting 1.23%. The S&P 500 tumbling 1.60%, and the Nasdaq Composite nosediving 2.24%. So what triggered this market mayhem? The answer lies in 2 key factors: the imposition of new U.S. tariffs on dozens of trading partners, and a shockingly weak jobs report. Tariffs. The trade war escalates. Just hours before the tariff deadline, President Donald Trump signed an executive order imposing duties on U.S. imports from countries including Canada, Brazil, India, and Taiwan. This latest round of levies has left investors and trading partners reeling as the global trade war intensifies. But that's not all. The move has also sparked fears of retaliation from affected countries, potentially leading to a further escalation of the trade conflict. Jobs data. A labor market in trouble? The U.S. job growth slowed more than expected in July, with the prior month's report revised sharply lower. This significant downturn has raised concerns that the labor market may be starting to crack, according to Brian Jacobson, chief economist at Annex Wealth Management.